Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines. Get ready for a deep dive into some fascinating stories making waves in the financial world today, from a potential Bank of Japan rate hike to big tech's upcoming earnings reports, Bitcoin's surge ahead of the election, Boeing's scramble for cash, and even a potential time bomb ticking away in the commercial real estate market,
Mm.
hitting even AAA-rated bonds, you might be thinking. What do all these things have in common? Well, that's where expert speaker comes in. They'll help us connect the dots and see how these seemingly isolated events actually paint a picture of the current economic landscape.
Yeah, it's all about understanding the interconnectedness of the global financial system. One event can trigger a chain reaction, and today we're seeing those connections more clearly than ever.
All right, let's kick things off with the Wall Street Journal and their analysis of the Bank of Japan's upcoming interest rate decision. They're saying a rate hike could be on the horizon.
It's definitely a possibility. The WSJ reports that despite some political uncertainty in Japan, with the ruling coalition losing its majority in the lower house, the Bank of Japan is still expected to signal that future rate hikes are on the table. This comes after they raised rates back in July, citing a weakening yen as one of the main reasons.
So the yen has been weakening. What does that mean exactly? And why is the Bank of Japan so concerned about it?
You see, when a country's currency weakens, it can lead to higher import prices, which can fuel inflation. The Bank of Japan has been trying to keep inflation under control, and a weak yen makes that job much harder now. The yen hit a 3-month low against the dollar recently. So the big question is whether the BOJ, that's the Bank of Japan, will risk further weakening the yen by hinting at more rate hikes or prioritize political stability. It's a tricky balancing act.
It sounds like all eyes will be on BOJ Governor Ueda's tone at the press conference. The WSJ suggests that markets will be scrutinizing his every word to see if he's leaning more hawkish, especially given the yen's recent performance.
Exactly. Ueda's comments could give us valuable insights into how worried the Bank of Japan really is about inflation and how committed they are to hitting their 2% inflation target. His tone could send ripples through the currency markets and even impact global interest rates.
So Japan's central bank decision could have far-reaching implications. This brings us to another market-moving event, big tech earnings. Barron's has a piece on how big tech earnings, particularly those of the Magnificent Seven, as they call them, NVIDIA, Meta, Alphabet, Apple, Amazon, Microsoft, Tesla, could impact the entire stock market this week. The stakes are high, especially given the recent market rotation away from these mega cap companies and into smaller companies.
It's a critical moment for these tech giants. Remember, they make up a significant portion of the S&P 500 and other major indexes, so their performance has a ripple effect throughout the market. But it's not just about their bottom line. Investors are also scrutinizing their guidance, their outlook for the future, and especially their AI strategies.
Right, because everyone's talking about AI these days. Barron's specifically highlights Alphabet and Meta. Alphabet's stock has been down due to concerns about their aggressive AI spending and increased competition, while Meta's stock is up, fueled by optimism about their AI efforts and virtual reality projects. Why such a difference?
It boils down to investor confidence and whether these companies can back up their AI ambitions with tangible results. For Alphabet, the question is, will their earnings justify those massive investments in AI? Can they demonstrate they're staying ahead of the curve and maintaining their dominance in search and advertising?
And for Meta,
Investors want to see if Meta can translate the buzz surrounding their AI projects and metaverse ambitions into actual profits. Can they monetize these new ventures effectively? That's the million-dollar question.
beyond Alphabet and Meta,
Hmm.
what about the other members of the Magnificent Seven?
Barron's points out some key things to watch. For Amazon, it's all about growth in their cloud business, AWS. For Apple, it's addressing concerns about slowing iPhone demand. And for Microsoft, it's proving that their heavy investments in AI are paying off. And let's not forget NVIDIA, although they're reporting a bit later. This week's earnings from other tech giants, especially Alphabet and AMD, are on the radar of NVIDIA investors because they could offer clues about the overall demand for NVIDIA's AI chips.
That makes sense. It's like a chain reaction.
Hmm.
One company's performance can have implications for others in the same industry. Now let's switch gears and talk about Bitcoin. Barron's reports that it's surging, nearing its all-time high above $71,000. And they attribute this surge, in part, to the upcoming U.S. presidential election.
It's fascinating how both Trump and Harris have adopted a more crypto-friendly stance than we've seen in previous elections, according to Barron's. Despite previously criticizing Bitcoin, Trump now supports it and has even pledged to create a Bitcoin strategic reserve. He's also been critical of SEC Chair Gary Gensler, who is seen as a tough regulator in the crypto space.
And Harris. What's her take on crypto?
She's been talking up crypto as one of the industries of the future, so it seems like regardless of who wins, the crypto industry could benefit from a more favorable regulatory environment.
But is one candidate better for crypto than the other?
That's what some analysts are saying. Behrens points out that a Trump win, with his proposed policies and criticisms of Gensler, could signal a more hands-off approach to regulation, potentially being more beneficial for crypto.
Interesting. So the election is definitely adding fuel to Bitcoin's rally. But Behrens also mentions other factors like the recent inflows into spot Bitcoin ETFs. What are those, and how are they impacting the price?
Think of ETFs as baskets of assets that you can invest in. Spot Bitcoin ETFs track the price of Bitcoin, making it easier for institutional investors, like large investment firms, to gain exposure to the cryptocurrency market. This increased demand is certainly contributing to the price surge.
So could Bitcoin hit $100,000, as some analysts predict?
That's the big question. Behrens even mentions that the Fed's interest rate policy could play a role. Lower interest rates tend to boost risk on assets like Bitcoin. So if the Fed continues easing monetary policy, it could add upward pressure to the price.
From a surging Bitcoin to a struggling Boeing. The Wall Street Journal is reporting that Boeing is raising a massive $21 billion in equity. That's a huge amount of money. What's driving this desperate move?
It's a clear sign of the depth of their financial troubles. The WSJ highlights severe financial strain, ongoing cash burn, and that extended strike that has halted most of their airplane production. This equity raise is a lifeline.
So they're essentially trying to buy themselves some time and restore investor confidence.
Exactly. But it raises some important questions, too. Could this impact their credit rating? Could it lead to further actions like selling their space business, as the WSJ hinted? This move is a big deal and could have significant implications for Boeing's future.
It seems like we're seeing both the highs and lows of the market playing out simultaneously.
That's a great observation. And it's a reminder that the market is a complex and dynamic system, always in flux. Our job is to understand the forces driving these shifts and try to anticipate what might come next.
Speaking of shaky ground, this leads us to a concerning development in the bond market. Bloomberg has a feature about how the commercial real estate crisis is now hitting even AAA-rated bonds.
This is where it gets really interesting and concerning, to be honest.
Definitely. Bloomberg focuses on ASOSBs, which are single asset, single borrower, commercial mortgage-backed securities, basically. These bonds are backed by individual office properties. And what's happening is that even those with top-rated AAA ratings are now experiencing losses for the first time since the financial crisis.
The pandemic-induced shift to remote work has completely upended the office market. Occupancy rates are plummeting in cities across the country, which leads to declining property values and ultimately defaults on these bonds. Bloomberg even highlights the case of 1407 Broadway in Manhattan, a prime office building, once a rock-solid AAA-rated asset, now facing foreclosure.
That's a stark reminder that even the seemingly safest investments can be vulnerable to unforeseen circumstances.
It is, and Bloomberg points out that this isn't just happening in Manhattan. Chicago, San Francisco, Los Angeles, and several other cities are seeing similar challenges in their office markets.
So is this a sign of things to come for other asset classes? Could we see a similar reckoning in, say, residential real estate or even corporate bonds as interest rates rise and the economy slows?
That's the big question, isn't it? Unfortunately, there's no easy answer. But the commercial real estate crisis serves as a warning. It reminds us that no investment is truly risk-free and that we need to be prepared for unexpected events. It's certainly a wake-up call for investors. But on that note, let's shift our focus to a potentially brighter spot. MarketWatch is highlighting BlackRock CEO Larry Fink's comments from the Future Investment Initiative in Saudi Arabia. He offered some interesting insights into the market's trajectory.
Ah, Larry Fink, always a thought leader in the finance world. What's his take on the current market conditions?
Well, he acknowledges that price-to-earnings ratios, or PEs, which are a common way to value companies, are at extreme levels. But here's the interesting part. He's still optimistic about future growth.
Extreme, but not too extreme.
That seems to be his stance. MarketWatch quotes him as saying, "We're seeing earnings catch up to the PEs," which suggests he believes corporate profits will continue to grow, justifying those high valuations. And get this. He thinks the old playbook of higher interest rates slowing down the economy might not be as reliable anymore.
Really? That's a bold statement. Why does he think that?
He points to a couple of factors. First, an aging population leads to higher savings rates, which could offset some of the dampening effects of higher rates. And second, because most Americans with mortgages have those 30-year fixed rates. The impact of higher interest rates is spread out over a much longer period.
So the economy might be more resilient to higher rates than we think.
That's what Fink seems to be suggesting. And if higher interest rates aren't going to slam the brakes on the economy, what does he see as the engine for future stock market growth?
I'm all ears.
He's placing his bets on the massive investments required for digitization and decarbonization. He even uses Walmart as an example, highlighting how they're using AI to manage their retail space.
That's interesting. So he's saying the need to modernize infrastructure and transition to a greener economy will create huge investment opportunities.
Exactly. He points to the trillions of dollars sitting in money markets, waiting to be deployed. Fink seems to believe this capital will flow into these large-scale projects, driving economic growth and boosting the equity markets for years to come.
That's a compelling argument, especially when you consider that those trends, digitization and decarbonization, are only going to accelerate in the coming years.
These aren't short-term fads. They're fundamental shifts reshaping the global economy. And companies at the forefront of these trends, the ones developing the technologies and building the infrastructure of the future, are likely to be the big winners. It begs the question if Fink is right. Are we at the beginning of a new bull market, driven by these tectonic shifts, one that could even withstand rising interest rates?
Now, that's a thought-provoking question. But speaking of thought-provoking, MarketWatch also mentions Citadel CEO Ken Griffin speaking at that same Future Investment Initiative event. What insights did he offer?
He believes that the reduction of uncertainty after the U.S. election will be a major catalyst for the markets, regardless of who wins.
So he's essentially saying that the market hates uncertainty, and once the election is settled, we could see a risk-on environment as investors gain clarity on the future policy landscape.
Precisely. MarketWatch quotes him saying, "The reduction in uncertainty is almost always positive for asset prices. And right now, with the election so close, that uncertainty is at a peak." He believes that once that uncertainty lifts, people will be more willing to invest, whether it's under a Harris administration or a Trump administration.
Both Fink and Griffin seem to be looking past the short-term noise and focusing on the longer-term drivers of growth. It's a refreshing perspective.
I agree. It's a valuable reminder that successful investing often requires taking a step back and looking at the bigger picture, sometimes. Those big picture trends can even overshadow immediate political or economic uncertainties.
Okay, let's continue our global tour of financial news. The Wall Street Journal has a piece about HSBC posting higher quarterly net profit and announcing a $3 billion buyback program.
That's a solid performance for HSBC, especially considering the geopolitical tensions and economic headwinds they've been facing. The WSJ mentions that their net profit actually rose by 9.2% year over year.
That's impressive. What's driving their success?
It seems they're benefiting from higher fee and trading income, even though their net interest income took a dip. Now, you might be wondering, what is net interest income?
You got it. I was just about to ask that. Break it down for us.
It's basically the difference between what a bank earns on loans and what it pays on deposits. Think of it as a bank's profit margin on its lending activities. A decline in net interest income usually indicates that a bank's core lending business isn't doing as well.
So that dip in net interest income for HSBC is probably a reflection of the global economic slowdown.
Right. But the fact that they're managing to offset that with strong performance in other areas like fees and trading is a good sign. It shows they're diversifying their revenue streams and adapting to the changing market dynamics. And that $3 billion buyback program is another positive signal.
What does a buyback program tell us?
It's when a company uses its own money to buy back shares of its own stock. It can be a way to return value to shareholders. Especially if the company believes its stock is undervalued, it can also boost earnings per share, making the company look more attractive to investors.
So it's a sign of confidence in their future prospects. They're putting their money where their mouth is. Speaking of smart moves, MarketWatch has an interesting article about McDonald's. They beat earnings expectations, but their stock is falling.
That's right. It's a head-scratcher for some. But it comes down to their focus on profitable growth. They're prioritizing margin over sheer volume.
So it's not just about selling more burgers, but about selling those burgers at a price that maximizes their profits.
Exactly. Their third quarter results show the strategy is paying off. They've maintained strong profit margins despite rising costs and some softening in consumer demand. But here's the catch. Even though they beat earnings estimates, their fourth quarter revenue outlook is a bit weaker than expected.
So the market is worried about their future growth potential. Hence, the drop in stock price.
That seems to be the case. Remember, the market is always looking ahead. And even a strong earnings beat can be overshadowed by concerns about future prospects. In McDonald's case, revenue growth is being prioritized as a key indicator of their long-term success.
It's always a balancing act for companies, pleasing both investors in the short term and meeting the long-term needs of the business.
Indeed. In McDonald's case, they seem to be betting that focusing on profitable growth will create more value for shareholders in the long run, even if it means a bit of short-term pain in the stock price.
It'll be interesting to see how this strategy plays out for them.
Hmm.
But we've talked about Bitcoin's surge ahead of the election. So what about the broader market? What's the potential impact of the election on the stock market as a whole?
That's an important question, and it's one that Bloomberg addresses in their market wrap-up. They highlight how investors are bracing for a potentially volatile week, with the U.S. presidential election just days away and a slew of earnings reports from major companies coming out.
It feels like a perfect storm of uncertainty. The election is tight, and these earnings reports could make or break the market's momentum.
It's definitely a high-stakes week, and Bloomberg even adds the Fed's upcoming interest rate decision to the mix. They meet next week, and there's still some debate about whether they'll cut rates again this year.
Right. And Bloomberg polled several finance bigwigs at that Future Investment Initiative event about this very topic. The consensus seemed to be one more rate cut this year,
Oh,
but probably not two.
you've got a good memory, so. It's not just the election and earnings creating uncertainty. The Fed's policy path is also up in the air. No wonder investors are feeling a bit jittery.
Jittery is an understatement. But back to the election. Bloomberg mentions a Bloomberg Markets Live Pulse survey that found a Trump victory could be more beneficial for stocks and Bitcoin in the short term.
That's interesting. Why do they think that?
According to the survey, Trump's policies are seen as potentially leading to increased deficits, which could stimulate the economy in the short run, even if it means higher inflation down the road. And his more hands-off approach to crypto regulation is also seen as a positive for Bitcoin.
So the market is betting on a short-term boost under Trump.
That's one interpretation. But the survey also found that a Harris presidency could be better for housing costs, perhaps due to her focus on affordable housing policies.
It's fascinating how the market tries to anticipate the potential impact of different policy agendas. It's like a giant prediction machine, constantly processing information and adjusting its expectations.
It's not always accurate, of course, but it's a reminder that the market is more than just numbers and charts. It reflects human psychology, our hopes and fears, and our beliefs about the future.
Exactly. Speaking of human psychology, let's not forget about the impact of earnings season. CNBC has a live blog covering all the market action, and they're highlighting a few other noteworthy developments, including both positive and negative earnings surprises.
Okay, give us the good news first.
Pfizer and Chipotle both beat earnings expectations.
That's a good sign. What about any negative surprises?
Unfortunately, yes. Ford Motor is down sharply after lowering their full-year earnings guidance.
Not a good sign for the auto industry.
No, it's not. And remember, this is the busiest week of earnings season, with several tech giants like Alphabet, Meta Platforms, Microsoft, and Apple all reporting.
Their results could really move the market,
Yeah.
especially after NVIDIA's recent blowout quarter. That set a high bar for other tech companies, especially those heavily involved in AI.
Absolutely. NVIDIA has set the tone for this earnings season, and investors will be watching to see if other tech companies can match their performance.
Speaking of AI, MarketWatch has an article about Palantir, the data analytics company. They're now worth $100 billion and are being compared to NVIDIA in terms of their success in incorporating AI into their business.
Palantir has quietly built a strong presence in the AI market, and their recent surge in valuation reflects their success. It's another example of how AI is rapidly transforming industries and creating opportunities for investors.
AI is definitely the hot topic right now. But before we get too carried away with the future, let's bring it back to the present. CNBC is reporting on some drama unfolding at JP Morgan Chase.
Oh, no, what's happening?
Apparently, JP Morgan is suing customers who allegedly exploited a so-called infinite money glitch to steal thousands of dollars.
An infinite money glitch? That sounds straight out of a video game.
It does. But for JP Morgan, it's all too real. CNBC doesn't provide many details, but it seems like these customers found a way to exploit a flaw in the bank system to create money out of thin air.
That's incredible, and a major headache for JP Morgan. Not only are they out the stolen money, but they have to deal with the reputational damage and the potential for copycat attempts.
It's a reminder that even the most sophisticated financial institutions are vulnerable to human error and ingenuity. In the digital age, security is more important than ever.
Absolutely. This story is a cautionary tale for both banks and customers. Banks need to constantly invest in their security systems to stay ahead of those trying to exploit them. And customers need to be vigilant about protecting their accounts and reporting any suspicious activity.
Great advice. And on that note, I think it's time to wrap up this segment of our deep dive.
Agreed. We've covered a lot of ground today. From the macro trends shaping the global economy to the micro-level dramas playing out in individual companies.
It has been a whirlwind, but as always, it's been a fascinating journey exploring the complex and ever-changing world of finance with you, expert speaker.
The pleasure is all mine.
And to all our listeners, stay tuned for the final segment of our deep dive, where we'll connect the dots between these seemingly disparate stories and offer our insights on what it all means for you. All right, listeners, welcome back for the final part of our deep dive. We've covered a lot of ground today, from the Bank of Japan's potential rate hike to big tech earnings, Bitcoin surge, Boeing's challenges, the commercial real estate crisis, and so much more. Now let's connect the dots and see what it all means for you, expert speaker. What are some of the key takeaways that stood out to you from today's stories?
Well, one thing that really jumps out is the theme of uncertainty. The upcoming U.S. election, the Fed's next move, the future of the office market. It feels like we're standing at a crossroads with many different paths ahead of us. And this uncertainty creates both risk and opportunity.
So what does that mean for investors like you and me listening right now?
It means we need to be extra careful, maybe even a bit more cautious than usual. This is not the time to put all your eggs in one basket. Diversification is key. Focus on companies and assets that can potentially weather a variety of economic storms.
So spread the risk, stay informed, and be prepared for things to get bumpy.
Exactly. Remember that Barron's article about oil prices taking a nosedive after those strikes in the Middle East? The price of oil is another big question mark right now.
Right, and energy prices have a huge impact on everything. Inflation, consumer spending, even how companies do business. It all ties back to energy.
It just highlights how interconnected everything really is. Geopolitical events can send shockwaves through the financial markets. Economic data can influence political outcomes. And technological advancements can disrupt entire industries. Think of it like a giant web. Tug on one strand, and the whole thing shakes.
Wow, that's a powerful image. So we need to be aware of these connections and how they can impact our own financial decisions.
Absolutely. And it's not enough to just know what happened. We need to understand why it happened and what it might mean for the future.
Speaking of the future,
Yeah.
we can't forget those long-term trends we talked about. Digitization, decarbonization, the rise of artificial intelligence. These aren't just buzzwords. They're reshaping the world as we know it.
Exactly. Remember Larry Fink and Ken Griffin? They both seem to agree that those trends are the real drivers of growth and wealth creation, regardless of what happens with the election or the Fed.
So are you saying we should be looking for companies that are riding those waves of innovation?
It's definitely something to consider. We saw how NVIDIA's stock has exploded thanks to the AI boom. They're not alone either. Companies like Tesla, Amazon, and Microsoft are also making big bets on those transformative technologies.
So someone is looking for investment opportunities.
Yeah.
Those are some good places to start their research.
Absolutely. But again, diversification is key. Don't put all your eggs in one basket. Even if that basket is full of futuristic, exciting companies.
Great advice, expert speaker. Thanks for breaking it all down for us today. I think we've all learned a lot.
It was my pleasure. It's always a fascinating conversation.
And to our listeners, we hope this deep dive has given you some food for thought as we navigate these uncertain times. Remember, knowledge is power. The more you learn, the better prepared you'll be to reach your financial goals. One final thought for you to ponder. How might these global trends, from the Bank of Japan's monetary policy to the commercial real estate situation in the U.S., ultimately affect your own financial decisions? It's a question worth considering as we wrap up this year.
Indeed. And as always, stay curious, stay informed, and stay engaged. The financial world never stands still, and there's always something new to discover.
Well said. We'll see you all tomorrow morning with new headlines from major financial magazines.